Hi, welcome to Slay the Spider. I'm Jim B, and I'm the creator and host of Slay the Spider. Shares of the S&P 500 are called S&P Depository Receipts, SPDRs. Spiders. Slay the Spider means I intend to beat the S&P 500 quite substantially. This is a chart of the S&P 500 ETF SPY, the Spider chart. On January 4th, the SPY peaked at 479.98. On January 24th, the SPY dropped below a 10% decline and hit a low of 420.76. The difference between that high and low is 59.2 points. In a classic Fibonacci series, we would expect a rebound of 61.8% of the loss, or a rebound of 457.35. On February 2nd, the market hit a high of 458.12 and closed precisely at 457.35. Voila, a classic Fibonacci recovery was completed. The market then declined for a few days and rallied and put in a double top at 457.52. What's next is move down to where we break the 10% mark from the high at 480, which is SPY 432. Then a slight 3% move down below the 420.76 low mark set on January 24th. Once that's done, first a 5% move down to about the 400 SPY level. Then a very fast and very big move down to the market bottom at fair valuation. What is a fair valuation? As of February 18th, the S&P 500 is trading at a price-to-earnings ratio of 24.46. I think in a rising interest rate environment with inflation, like now, a generous PE would be 16. That puts the SPY at 284, which represents a 34.5% drop from here on 218, and a 29% drop from SPY 400. Please be aware, the markets historically have not gone to fair value and stopped going down at fair value. It's like a pendulum, going past fair value and then rising back to fair value. It's an emotional thing. Perhaps I will be proved wrong that fair value is an S&P PE of 16 and SPY 284. Perhaps fair value is 20. That still moves the SPiDeR down to 354. But I think 20 is far too high a PE when we are expecting 5 to 7 quarter point interest rates in 2022. For the week ending February 18th, the movement was mostly down. In healthcare, biomedical, and healthcare declined, and drugs were unchanged. In media communications, all three sectors declined. In technology, semiconductors, computers, and software declined. Electronics were unchanged. In consumer discretionary, gaming, restaurants, and leisure declined. Autos advanced. Retail and household products declined. In financials, banks declined. On the bear side, all the sectors declined except savings and loans, which advanced. In industrials, on the bull side, steel was unchanged. On the bear side, metals, arrows, building products advanced. Chemicals, machine tools, and waste were unchanged. In the others group, on the bull side, forest products advanced and oil declined. On the bear side, oil services advanced, gas utilities and electric utilities declined. Food declined, transports advanced, business products and textiles were unchanged. Precious metals advanced sharply, while protection and safety declined. For the week ending 2/18, there were 7 sectors unchanged, 10 sectors advanced, 23 sectors declined. 0 sectors crossed from the bear side or the bull side. There are now 9 on the bull side and 31 on the bear side. For the week ending February 18th, the S&P 500 closed at 4349, down 69, or 1.58%. The Dow Industrial Average closed at 34,079, down 658 points for the week, down 1.9%. NASDAQ closed at 13,548, down 243 points for the week, or 1.76%. This week, 188 stocks moved from buy signals to sell signals. There were 15 new issues. We now have 36% of stocks on buy signals and 64% on sell signals. Overall, the market score last week was 38. This week, it's 31. For the first 7 weeks of 2022, the S&P 500 is down 8.8%, and NASDAQ is down 13.4%. Energy is up 22.6% in the best performing sector. Healthcare is down 9.5%. Media communications is down 13.2%. Technology is down 12.3%. Consumer discretion is down 11.9%. Finance is up 0.4%. Industrials are down 7.2%. Real estate's the worst performing sector, is down 13.8%. For the past week, the S&P 500 was down 1.2%. NASDAQ was down 1.8%. Energy was down 1.1%. Again, outperforming both the S&P and NASDAQ for the week. Energy is the best performing sector for the year. For the week, healthcare was down 1.0%. Media communications for the week were down 2.7% and the worst performing sector of all the major sectors. Technology for the week was down 1.5%. Consumer discretionary stocks were down 0.2%, the best performing sector of the week. Financials this week were down 2.2%, well below both NASDAQ and the S&P 500. This week, the industrials were down 1.0%, outperforming both the S&P and NASDAQ. Real estate this week was down 1.7% and is the worst performing sector this year. This is a 3-week chart of the 10-year Treasury bond yield from January 31st to February 18th. The gap up on the opening in the last 2 weeks have been indications of worry about inflation and the Fed raising interest rate. This week, the gaps down are indication of flight to safety due to the Russia-Ukraine situation.